Hello and welcome to this PowerPoint presentation focused on Treasury Management. In this presentation we will review basic concepts and terminology and define key roles and functions within Treasury Management. We will also discuss in detail how technology is impacting the Treasury Management processes, offering us Treasury Management systems and an array of other very valuable tools. My name is Mark Hamilton and I am the CFO and Treasurer for CDG Engineers and Associates. During my career as a CPA, I have worked in public accounting with Deloitte & Touche and with KPMG, and have served in business and industry in both publicly traded and privately held companies as a senior tax executive, senior risk management executive, treasurer, and CFO. During my more than 25-year career, which has coincided with the maturity of the Internet, I have served as a technologist within each of the organizations that I have worked with. In these roles, I have played a significant part in introducing new technology and process improvements. Over this same window of time, we have seen dramatic transformation in Treasury Management. Currency and coins and checks have been displaced by card, ACH, and e-banking transactions. Banking back-office data processing has moved into our cloud ERP systems, and robotics reconciliations are gaining usage. We now find ourselves at the early adoption stage of what many believe will be the next transformational technology, which is called blockchain, or distributed ledger technology, also known as DLT. The function of DLT and the associated digital currency or cryptocurrency is redefining trust and will soon begin to transform Treasury much as the Internet transformed communications. I look forward to sharing with you this conversation about Treasury Management and hope you will gain better insight into the value that can be created from adopting technology and best practices. To get started, let's take a moment to define the primary learning objectives of this presentation. The first objective for us is to gain clarity on key roles and functions within the Treasury Department. Next, I want us to gain insight into the functionality and effectiveness of Treasury Management systems and the value that they bring to a Treasury Department. The last, and in my opinion most important objective, is that we use this discussion as an opportunity to gain a think digital mindset. The AICPA course, Developing Your Digital Mindset, focuses on the cultural implication of creating a digital mindset. It states that a digital mindset involves seeking to implement and embrace effective digital solutions in as many areas and interactions as possible. The immediate need to think digital first is nowhere more impactful for a company than in Treasury Management. Think of this for a moment. As fast as the pace of disruption and technology innovation seems, it is as slow today as it ever will be in the future. Organizations can manage the risk of being left behind by strategically shifting to a culture that thinks digital first. Now let's begin our discussion today by taking a look at the question, why is Treasury Management important? Two significant value attributes of Treasury Management are identified on this slide. The first value identified is that the Treasury Management team manages the balance sheet of a business. Providing effective processing, accounting, reconciliation, and reporting to management enables the company's operations and infrastructure to function smoothly. As Treasury professionals, we all understand that Treasury Management involves touches across the balance sheet. From the cash management processes, collections, managing investments and other financial assets, to payment processing, working capital management, and debt financing. Our goal in all of these activities is to create value by optimizing liquidity and optimizing the cost of capital. Each of these has a direct and significant impact on increasing return on equity and maximizing shareholder value. With any organization, optimization is bound by risk appetite. Effective risk management and forecasting are essential to both smooth functional operations and maximizing shareholder return on equity. Now let's take a look at defining what is Treasury management. First, let's define the typical roles within a Treasury department. The first role is that of cash management. Cash management is the process of collecting and managing cash flows. Effective cash management is a key component of a company's financial stability. Cash management is responsible for investing idle cash and optimizing cash levels necessary to ensure smooth cash flow. This requires effective processes for planning, controlling, and managing cash flows. The primary objective of cash management is avoiding insolvency. The challenge of this objective is to optimize utilization of funds while addressing working capital needs and the need for planned and unplanned expenditures. The next role is working capital management. Working capital management is the process of managing the differences in current assets and current liabilities. Objectives of working capital management include ensuring a smooth operating cycle with the goal of achieving the lowest cost of capital and highest possible return on current asset investments. Next, let's discuss forecasting, both cash forecasting and liquidity forecasting. Cash forecasting is the process of establishing an estimate or forecast of a company's future financial position. This is an important core planning component of Treasury management. Cash forecasting, using statistical trend analysis, has been the traditional method of modeling. This process analyzes historic cash flow data and uses it to predict future cash flow. For Treasury, this modeling method has the advantage of ease of access to data since all cash flow information is housed in or is easily accessible by Treasury. Typically, starting at the business unit level, statistical models are developed from prior year history and known cash flow changes are added. The business unit forecasts are consolidated and adjustments are made for known changes at the corporate level. This consolidated forecast creates a static view of cash flow for the forecasted period. Actual cash flows may be compared to the initial forecast, but few companies reproject the coming periods to project a more accurate picture of the remaining forecast. The major issue with these statistically generated forecasts is that they are created by looking back, and in many cases, last year's data does not predict what will happen the following year. Fundamental changes in variables or changes in the economy can have substantial effect. Liquidity planning is another financial forecasting tool that has more focus on planning. Liquidity planning means ensuring that a company always remains solvent for the foreseeable future. Liquidity planning will also provide insight into how much free liquidity will be needed to manage over the short, medium, and long term. Liquidity planning is a holistic approach of looking forward. This approach begins with a top-down view of cash flows and applies cash application rules to the operating budgets to establish cash flow targets. These cash flow targets and the metrics are used to establish KPIs throughout the company. Comparison of bottom-up planning process views derived from business unit forecasts allows opportunity to reconcile differences in creating an initial plan. This plan serves as the basis for executing the appropriate treasury management functions to meet the company's goals. Since forecasts are educated estimates and predictions, The most important part of liquidity forecasting process is the constant monitoring and adjustment of actual cash flow performance versus the plan. A consistently applied variance analysis helps anticipate and significantly decrease the surprises. A strong liquidity planning tool allows for top-down and bottom-up practices, as well as a comprehensive variance analysis and reforecasting process. A system of key performance indicators should also be incorporated to provide an early warning mechanism if actual or reforecasted cash flows vary too far from the indicators. This process can seem overwhelming and intimidating. However, the key to successful implementing an effective liquidity planning is simplification. It is often quoted, "If you fail to plan, you plan to fail." This simple but undeniable truth has been attributed to great minds from Sun Tzu to Benjamin Franklin, and it is as true today as ever. Next, let's take a look at the Treasury management role of managing banking relationships. Banking relationships are the lifeblood of Treasury management. It may be as simple as managing a one-bank solution to the complexity of global finance. Most organizations, at a minimum, will engage a primary bank for significant banking needs and will also maintain relationships or divert some nominal or situational treasury activity to an alternate banking partner. It is very important in banking relationships to have as good an understanding of your banker's strengths and weaknesses as he will want to understand about your company. Insist on transparency and value the banker as a business partner to ensure a strong relationship. Very intentionally, you should avoid conflict of interest of any kind. Lastly, always have an appropriate alternative course of action. Seek out strong people with diverse expertises and a keen awareness of technology innovation. Treasury management is also responsible for credit rating agency relationships. Credit rating agencies work to reflect the company accurately to the investor community. It is important to gain confidence by providing transparency and establishing trustworthiness. Building good relationships with rating agencies is a Treasury management long-term, time-intensive process. Treasury professionals should have an understanding of the importance of ratings, what ratings are, and how they are used. This will help enforce the investment in building and maintaining rating agency relationships. Treasury also has responsibility in credit granting. The credit granting process is necessary to ensure that a company does not grant credit to customers that have a risk of defaulting on payment. The credit review or underwriting procedure and the monitoring and compliance activities are important to customer relationships and managing a smooth operating cycle. Treasury has an ever-increasing role in developing strategic initiatives. Essentially, any significant strategic initiative includes a variety of Treasury implications. As we have seen in the roles defined above, Treasury works daily with money markets, capital markets, risk management, and capital assessments. Treasury professionals have mastered new skills over the past couple of decades and have evolved leadership in roles such as capital budgeting, enterprise risk management, and mid and long-range liquidity management. Given the strategic importance of the many roles Treasury is associated with, assessing these has critical implication in aligning a company strategy with the market. Now let's take a look at the key functions of a Treasury Department, starting with developing Treasury policies. The overall responsibility for risk management within a company lies with the Board of Directors, who typically delegate the daily management of risk to responsible individuals in each department. In the case of financial risk, many of these responsibilities are delegated to the Treasurer. Treasury policies are the tools used by the Board or Risk Management Committee to delegate financial decision making in a controlled manner. Typical Treasury policies govern a variety of Treasury activities. These include activities such as foreign exchange risk, interest rate risk, or policy for surplus cash investments. An inclusive Treasury policy framework allows the Treasurer to organize Treasury activities and ensure compliance with the policies. The framework should make clear what objectives or goals Treasury is expected to achieve and how success will be measured, and what decisions are delegated to the Treasurer and what circumstances define when the Treasurer should refer decisions back to the board or another person or body within the company. Establishing a Treasury system is also a key function of the Treasury Department. Many companies are making Treasury management systems a priority, and we will discuss Treasury management systems in more depth in our next slides. Treasury management solutions have the potential to improve cash forecasting, protect companies from fraud, and boost the efficiency of the Treasury Department. It is important for Treasury departments to know what they need to get out of their Treasury management system. The objective of a great Treasury management system is to create an environment where all necessary pieces fit together and work in harmony. Most typically, the focus of Treasury management systems is initially driven by concern with managing payment processing and payment fraud, or the desire to aggregate multiple bank account data sets to establish real-time reporting information representing a single source of truth. The return on investment in a Treasury management system can be significant. Portfolio management is another key function. Treasury management requires balancing liquidity and funding with the goal of optimizing cost of capital and return on investment. Efficient management of the investment portfolio is essential to achieving these objectives. Primary drivers of success and value creation in portfolio management are minimizing funding excess by establishing the right level of liquidity, which requires determining the right balance of short-term and long-term debt and the appropriate level of debt versus equity, and establishing real-time data availability in an organized reporting process that aids improved decision-making. The next function is that of identifying funding opportunities. Traditionally, funding sources have been split about 70% from bank loans and about 30% from public bond offerings. However, recently there has been an increase in competition from private direct lending, largely driven by evolution in fintech. Fintech, or financial technology, is a term that can be applied to any innovation that impacts how people transact. Throughout the development of the internet, we have seen fintech grow explosively. These technology innovations are responsible for introducing Treasury management systems as well as introducing digital money. Since the primary funding remains with banks, identification of funding opportunities is largely a result of banking relationships and gaining trust. The final key function we will discuss is Treasury risk management. Most typically, the primary risks that Treasury management is responsible for are foreign exchange risks, interest rate risk, and the associated counterparty risk, and in some cases, commodity risk. In our global economy, multinational companies often are required to buy and sell in multiple currencies in many countries. For those organizations, foreign exchange risk is a significant exposure. The exposure may be related to transactions, selling, or buying, or banking transfers or loans. It may also impact consolidated accounting reporting when companies hold foreign assets or liabilities. Interest rate risks arise when a company is exposed to changes in interest rates. This may result from significant outstanding floating rate debt or from extending fixed rate credit to customers. Interest rate risk also occurs related to portfolio management if the yield curve shifts are not aligned with the bond duration models. This is commonly referred to as yield curve risk. Counterparty risk is a risk that a counterparty defaults on its contractual obligation, and we see this as the offset to floating interest rate risk in interest rate swaps. This risk is typically managed by monitoring the periodic mark-to-market. Commodity risks are specific to consumers and producers of commodities and are driven by market changes, seasonality, and political or regulatory change. Okay, now that we have defined the typical roles and functions within Treasury management, I'd like to take a moment and do a priority check. Take a look at this slide. Within your company, what are the top priorities for the remainder of 2019 and 2020? I'm going to pause for a few moments and allow you to rank these items: cash forecasting, banking relationship management, Treasury risk management, Treasury management systems, banking fees, operational efficiency, balance sheet optimization, cybersecurity, staffing, and Treasury functionality. Okay, now let's take a look at the results of a survey conducted by Treasury Strategies, the 2018 State of the Treasury Profession. So now let's look at the 2018 State of the Treasury Profession Survey. And let's take a moment to compare the priorities that you just set with the results of the survey. I find it interesting that the top 4 items have essentially remained constant over the survey period. How does this result compare with your thoughts on your company's priorities? Cash forecasting, Treasury risk management, a Treasury management system, and a functional Treasury organization seem to be clear priorities of focus for Treasury departments. A couple of other points I would like to make about these results. In my opinion, cybersecurity is too low. I cannot overemphasize the importance of cybersecurity, and I would recommend that every finance professional, particularly every CPA, should fully educate themselves on the world of cybersecurity. The AICPA offers a very good 8 to 24-hour continuing education course that will provide valuable insight. I would also recommend that anyone interested in working with cybersecurity to assess this within your company should take a look at the NIST cybersecurity framework. This documentation can be found at nist.gov. This framework is an organized structure for evaluating cybersecurity holistically for an organization and is directly applicable to all functions and all business units. Please visit your state society website or aicpa.org for more information on the available cybersecurity educational content. Again, I cannot stress enough the importance of gaining high priority for cybersecurity. In the global business environment that we operate today, big data, the systems that we manage our data on, and the interconnectivity of all of our infrastructure has become critically valuable. In 2018, our infrastructure was attacked and a significant data set was held ransom through the use of a ransomware bug. The experience was horrific, but it taught me many lessons and gave me an appreciation for the need for education. One of the most important lessons is that you can't ignore the problem and assume that they are just problems of others. It is imperative that the leadership proactively and continuously assess risk and invest in protection. We must train employees and instill a culture that prioritizes cybersecurity importance. For further insight on this topic, I would reference you to Treasury and Risk article, Arming Corporate Treasurers for Cyber Crime Combat. 3 steps for building the right policies and processes to defeat modern and evolving cybersecurity threats. This article and others that I will reference throughout the presentation today can be found at www.treasuryandrisk.com. I would also comment on the continued lowering of the banking relationship priority. I find this very interesting. In one aspect, it is concerning, but from the perspective of fintech, internal systems handling more banking functionality, transformation of transaction processing, and alternative funding sources, it would seem to be that this impact may be very positive. Now let's take some time to look in a bit of detail at the item identified as the 3rd priority on the survey chart, Treasury Management Systems. I suggest that this priority is the foundational tool that is employed to drive success to many of the other priorities listed. To gain further insight and a greater sense of the state of the Treasury Management Systems, I would like to share reference to a few Treasury and Risk articles of interest. The first being Treasury Management Systems Implementation, a Worthwhile Challenge, dated May 14, 2018, which shares how companies are increasingly seeing the benefits of Treasury Management Systems, but recognizes that adopting the technology has pitfalls. This article provides best practices that will make the transition less imposing. The second article is the benefit and ROI of a Treasury Management System from April 1st of 2019, which gives you information on building a better business case for Treasury Management Systems. And then last, a total rundown on Treasury Management System costs from August of 2019 offers best practices for quantifying the value of a prospective investment in Treasury technology. On the next 2 slides, we're going to take a few minutes to look at Treasury Management Systems in an outline format that will allow us to organize our thoughts about what they are and how they function and work together. The first slide breaks Treasury Management Systems into 4 portals. These are the Treasury Front Office, which interconnects systems and data from capital markets; the Treasury Middle Office, where Treasury policies are maintained and enforced; the Treasury Back Office, which interconnects the electronic banking accounts and data; and lastly, the Treasury Management Reporting Portal, where near real-time data can provide reports and dashboards for better decision making. The next slide provides the next level of insight into the Treasury Management System structure. The Treasury Front Office portal connects with the capital markets and provides links to data and the availability to transact in foreign exchange markets, debt markets, and fixed income markets. In the middle office, Treasury policy oversight responsibility entails policies covering such areas as foreign exchange risk, commodity risk, debt portfolio management risk, loan compliance, interest rate risk, and lastly, surplus cash investments. The Treasury Back Office portal provides the interconnectivity with the digital banking environment. This portal is primarily focused on aggregating all banking accounts. It will allow for smooth processing of disbursements and processing of collections and provide tools for balancing working capital. Equally important, the one source environment allows functionality for real-time reconciliation of accounts and establishing interconnectivity with the company's enterprise resource planning systems and ledgers. The Treasury Management Reporting Portal is where the real-time data is established in analytical reports or dashboards. The extent of data analytics and reporting is limitless, using data from the one source environment. Treasury insights such as reporting liquidity, planning variances to KPIs in near real-time dashboards is realistically achievable. Now that we have a high-level perspective of Treasury management structure, we should recognize that the Treasury Management System software acts as the interface to data and databases that are created by aggregating connected data using defined Treasury policies. At this point, I would like to take a moment to think about the functionality, usefulness, and risks of robotics and artificial intelligence programming in context of a Treasury management system. How far can automation go to eliminate tasks and redundancies? Where is the proper balance of investment and efficiency considering the risks? I would suggest that while these programming procedures seem abstract or system limited, the applicability of using program procedures is becoming more mainstream. For a very thorough walkthrough of the business transaction cycle implication and opportunities associated with the use of big data and fintech components such as deep learning, machine learning algorithms, and robotics process automation, I would reference again a Treasury and Risk article entitled AI and Machine Learning in the Order to Cash Cycle from October of 2018. In this article, they describe how companies can harness artificial intelligence to reduce errors, increase customer service, and improve efficiency from order fulfillment to payment collection. On the analytical side, since the deliverable of the system is the one source database for everything Treasury, all of the functionality of big data analytics and visualization are available. The limitation is defined only by the amount of investment and the user skill set. As we look at the priorities and focuses of initial implementations, many of the tools that we will discuss, those that interface seamlessly into a Treasury management system, may be being used independently and may already be in place within your company. However, without a Treasury management system, the use of each one of these tools within its own individual environment must be managed manually, each with its own login and credentialing and with its own system limitations. This manual effort requires significant uses of time, and staffing was the number 6 priority in 2018. The adoption of a Treasury management system is, however, frequently impacted by the staffing challenges. Treasury job descriptions in a Treasury management system environment would look like Treasury data scientists, which would include roles as analyst and reporter, or Treasury business process manager, or Treasury approver. Talent skill sets was also the number 6 priority in 2018. Let's now focus our conversation on 4 key functionalities that typically have broad impact on most companies and are generally among the primary initial focuses of a Treasury management system implementation. The first 2 are collection and disbursements, both of these being significantly impacted by the ever-increasing methods of transacting and globalization of business. The first typical focus area is collections, with emphasis on making more methods of receiving payments and payment types available, streamlining collection processing, and centralizing the processing of accounts receivable. Timeliness in applying payments, particularly in an environment where we're offering customer credit, is very important. The second typical focus area is disbursements. More than ever, there are a variety of ways of transacting payments. A valuable application of a treasury management system in this area is to create a centralized environment that allows for the variety of payments to be initiated securely and efficiently and processed from a central location versus having to go and disperse data through all of the different banks or through all of the different methods of payment independently. Again, one source of data also facilitates ease in reconciliation and reporting. The third focus area in treasury management systems is reporting. In most organizations, timeliness is critical to success. Maintaining near real-time treasury data aids in the decision-making process. Many times when you've learned information, it's already too late to act on it. The value is in allowing a convenient and secure way to manage all of the account data, centralizing it so that you have one source of treasury data that can be ultimately used to give real-time reporting perspective. The last area of focus for treasury management systems initial implementations is the area of managing cash surplus. For many companies, particularly companies with many banking partners, optimizing surplus cash balances in accounts at the end of each day is the most routine and numerous set of transaction activities. Optimizing the working capital aspect of cash flows on a daily basis requires convenience and efficiency in how you move and manage surplus cash, and the treasury management system provides an environment to streamline those activities. Next, let's summarize some of these key points and look at how treasury management systems help businesses operate more effectively. Businesses gain effectiveness by improving the accounts receivable collection processes. They also gain effectiveness by improving the accounts payable and disbursement processes. Businesses are more effective when they can easily access their financial data online and when they can feel comfortable with the system's ability to help detect and prevent fraud. Lastly, there is significant value in the effectiveness brought to the management of short-term investments. Let's look at each of these focus areas that we have previously identified and discuss some of the tools and functionality, some of the fintech that you are likely using or have interest in using. First, let's talk about collections tools. Many of these tools are likely already being utilized within your company. And as we previously pointed out, the value proposition for a treasury management system is in the centralization of the use of these tools across a multitude of providers. The first tool identified is the use of remote deposit. Remote deposit is the ability to deposit a check from a remote location without having to deliver the physical check. I would assume within most companies remote deposit is being used and many of the benefits of this tool are being recognized. Remote deposit scanners can capture and transmit encrypted images or encrypted electronic data over the internet to banks. Scanners can allow scans to be supplemented with user-defined information which aids in processing and other necessary documentation. Merchant services refers to the financial services provided by a credit card processor that allow a company to accept payment by credit card or debit card. Additionally, there are e-commerce merchant services such as PayPal, Venmo, or Square, and numerous online payment gateways. While credit card and e-commerce payments are a significant convenience for remitters, there is a financial cost to the receiver associated with accepting the payments through merchant services. There is also an additional layer of record keeping, as the reconciliation of remittances with invoices or POS systems may be problematic. Again, I would assume that most companies are accepting credit card payments and management of merchant services. Most companies take advantage of the use of lockbox services for receipt of customer payments and use remittances for centralized processing of deposits. The use of lockbox services for managing receipts when connected with a robust invoicing remittance process is a functional Treasury process that has a significant history. However, there are recent significant efficiencies that have been introduced by FinTech, and we're also seeing the use of image lock boxes increase in popularity. These services are geared around recognizing that more payment activity is moving away from actual mailing and distributing paper checks and moving toward more automated forms of payment, including sending electronic images of a check. Thus, the roles of lockbox processing are increasingly becoming more diverse and complex. More lockboxes is equal to more complexity. The last tool identified under collections is the use of optical character recognition. This tool works in conjunction with lockboxes to read information back from a remittance into the same data record that includes the payment detail from the check. Optical character recognition is most useful when there are a large population of somewhat generic data fields, such as common remittances. Recapture of data from the form is more efficient and accurate than manual processing. These are some of the key tools that are being utilized much more extensively, where the ability to interface all of the applications into a treasury management system exists. Creating a single source of data in a centralized location for these applications alone has value for most companies. Now let's take a look at some of the disbursements tools that allow secure and efficient payment initiation. The first tool, which we all are likely using a great deal, is the Automated Clearinghouse, or ACH. This includes processing wires and SWIFT payments as well. This type of electronic funds transfer is one I believe most every company is using as we work hard to move away from processing paper. Most companies have implemented an ACH payments for the efficiency, recognizing that there is a dramatic potential change in float associated with using ACH payments versus processing paper checks. The Automated Clearinghouse payments provide standardized data inputs and outputs, and the processing of the payments in this network is an efficient method of distribution of funds. There are timing limitations on payments, however, recognizing that funds must be available for transfer, and there is a timing lag on movement of funds between banks. Since these transactions are all initiated through the bank, managing across banks and payments from a variety of accounts can create complexity. The next tool in the disbursements is the use of Positive Pay. Positive Pay is an automated fraud detection tool. Banks require companies to transfer database information relative to the payment activity, which includes count number, check number, and amount of the payment, such that each payment presented can be matched against the list previously authorized by the company. This automation allows an effective ability to combat fraud. Once again, this is a very historic tool, and likely most everyone uses it. But we all have manual processes for creating, remitting, and vetting the use of Positive Pay. The third disbursement tool we will talk about in some detail is the use of credit card payments. Card payments have now become very mainstream and widespread. 10 to 15 years ago, when I began working with credit card payment systems, they were just beginning to become mainstream. I was involved with the Wells Fargo credit card system just after the Wachovia acquisition in 2008, where we implemented a $25 million travel and entertainment, fleet, and vendor card program, which included the use of virtual payments. Following the financial crisis, the use of corporate card payments has grown very dramatically. This method of payment has extensive fintech investment, and the functionality of card payment systems today is very robust. With the introduction of a lot of good online tools in the world of card payments, there's a significant opportunity for companies to consider making card payments for a variety of needs. Among the uses of card payment processing systems that take advantage of the efficiency and convenience of the payment system are employee travel and expense cards, company fleet cards, vendor card payments, employee payroll debit cards, and virtual cards. Use of card in travel and entertainment is very mature, and again, fintech applications for capturing documentation and organizing the necessary coding and verbiage are available. These tools allow extremely efficient mobility for employees and ease of managing this tedious transaction-based task. Onboarding vendors, variety in vendor card programs, variety of tools and payment schedules create management complexities. There is a great deal of sophistication that can be introduced based on the data set that is managed on the merchant services side of transactions. The merchant services data set is created through the merchant services transaction database, and it allows you to restrict and control the vendor usage, and also to define and automate necessary coding based on who or what vendor merchant codes are. Additionally, on the merchant services side, there's a very sophisticated data set that is created and could provide additional information to the company. This is most useful with company fleet systems. These card systems are uniquely designed to allow card payments, particularly at fueling stations, that require data inputs and are tracked on statements or reports. These cards are restricted to use with specific vendor types, and specific fueling dispensers capture and report an ever-increasing set of data. Dispensing systems are now also capable of capturing image and video, which can be easily associated with transactions. Fleet card systems are useful in aggregating a large volume of common transactions, automating the processing and payment cycle, and are useful in setting controls to manage vendor spend. The most significant opportunity in card payment as a disbursement method comes from making vendor payments with physical vendor-specific cards or with the use of a virtual card process. A virtual card process is one where vendor payments and pertinent invoice references are combined electronically with a one-time use set of card credentials for the specific amount of the approved payment, and is transmitted in an encrypted manner securely to the vendor. When implemented effectively, vendor card payment systems can negotiate a 1 to 2% rebate on the volume of payments processed. It is very worthwhile to add card payment to the disbursement tools for your company, and I recommend that you talk with several vendors in addition to your banker. If you are already involved with card payments, then you are aware of these efficiencies, but also of the data analytics skill set that is needed to create value from these tools. Payroll cards, generally debit cards, are another use of card disbursement tool that has some popularity. These have advantages where companies have large groups of employees that may not have banking relationships, and direct deposit is not an option. Again, the efficiency in process is not without creating another layer of transaction detail to be reconciled. For a very good, insightful discussion, again, I refer you to a Treasury and Risk article entitled Failure to Launch from November of 2018. This article helps us to understand how to identify and improve underperforming purchasing card programs. I would like to summarize the discussion related to disbursements by suggesting that each company should make an effort to modernize payments and not be left behind. To bring the payment process into the digital age, companies should develop a strategy that starts with education. With all of the educational tools and opportunities that exist today, developing talent and building skill sets is readily available and very cost efficient. Particularly for employees that may be displaced by automation, there is no better time than the present to begin learning fintech. Companies should make a conscious effort to develop an inclusive payment strategy. They should consider the costs and benefits associated with the applicable automation. This process should encourage new ideas and welcome opportunities to assess alternatives. Each alternative should be grounded in a solid use case and should be supported by gaining the necessary buy-in. Significant thought and planning should be invested in preparing for implementation, as there cannot be too much planning at this point in the effort. Successful implementation generally sets the stage for a successful strategic transformation. The final recommendation is to always focus on continuous process improvement. The rapid pace of change is dramatic, and implementations will frequently need significant improvements within just 18 to 24 months. Developing a process for making continuous improvement and developing a culture that appreciates and encourages continuous process improvement can create significant value for a company. The next significant area of focus for Treasury Management Systems initial implementation is ensuring that the Treasury Management System allows for secure and convenient interconnectivity with all of the company's banking account information. Information and reporting functionality from the variety of collection and payment solutions is necessary to ensure value creation and success of implementation. Systems must allow specialized reporting and the flexibility to implement concise, customizable dashboards. Dashboards should report on an exception basis and should offer KPI and variance functionality. These systems also allow for flexibility, offering very convenient management of user privileges. The final area of significant focus during Treasury Management Systems initial implementation is on tools that create opportunity to capitalize on excess cash positions or pay down balances. These tools include the investment sweep, the cash manager sweep or debt sweep, and the credit line sweep. These automated processes work similar in that they recognize the needs for funding from funding sources or recognize the opportunity to monetize excess cash. The investment sweep account is typically an account with a bank that offers investment options for idle funds. The debt sweep is a cash sweep where the mandatory use of free cash is to apply to outstanding debt. Generally, these sweep option processes will allow an option to obtain an appropriate approval before the mandatory payment is made. Credit line sweep accounts are very common in working capital management. This process acts to balance the checking account daily to zero and apply any excess funds against the credit line. These automated processes are reliable and effective. Most companies utilize sweep functionality, the coordination and reconciliation of which is centralized and made more transparent in a treasury management environment. The final topic that we are going to discuss today is looking at the current technology that is transforming treasury management. We have already touched on fintech and the existing application of technology, but for this discussion I would ask that you think more futuristically. We are going to look at some technology that I believe will be transformational to treasury management. New technology will empower transformational changes in finance, treasury, and the way society transacts. Think for a moment about the maturity and convergence of big data analytics tools that seamlessly process structured and unstructured data, and blockchain or distributed ledger technology and the evolution of smart contracts and the digital asset economy, the Internet of Things or the introduction of sensors, communication devices within the cloud creating a smart environment, and the promise of 5G data speeds which are up to 100 times faster than the current 4G. Okay, let's talk for a minute about big data. According to Gartner, a leading information technology company, big data is high volume, high velocity, and high variety information assets that demand cost-effective, innovative forms of information processing for enhanced insight and decision making. Big data conversations focus on processes such as analytics and business intelligence with data scientists, data mining, and visualization. Big data uses tools such as OLAP, cloud computing, Hadoop, and dashboards to better understand business. Big data offers opportunities to monetize data and challenge operational effectiveness. It encompasses access and usability of internal and external data that may be structured, unstructured, or streaming. The value in big data comes from the ability to predict trends and to make decisions from more informed scenarios. For more information on the topic of big data, there is an 8-hour continuing education course developed by the AICPA, which I also present, which is called Analytics and Big Data for Accountants. Please see your state society for a schedule of the availability of this course. Okay, the next topic that we're going to talk about a good bit is blockchain, or distributed ledger technology. Blockchain technology has disrupted the financial markets. Digital assets are now an accepted form of value exchange. Blockchain technology is the most efficient method of processing transactions as it eliminates the task redundancy and reconciliation costs that are required where intermediaries are required to form trust. The future ability to develop artificial intelligence, robotics, and the use of APIs in conjunction with a standardized smart contract environment will transform business operations and create advantages for early adopters. In an article that I recently submitted for publication, Blockchain Distributed Ledger Technology, an Introduction and Focus on Smart Contracts, I discussed how the rapid evolution of the blockchain and distributed ledger technology and the associated applications will require many changes in the way business is transacted and how transactions are recorded. In describing the distributed ledger technology as an adaptable database tool, I suggested that in its simplest sense, blockchain technology represents a new adaptable database that offers a method for creating transaction ledger entries, vetting and validating the transaction entry, and storing them in a tamper-proof ledger. The unique value created by use of this tool is that after posting an entry to the blockchain ledger, the technology transforms what is required to trust the validity of the change in the balance in the ledger. Historically, accountants and finance professionals have managed ledgers using double entry accounting and relied on third-party intermediaries such as financial institutions to transfer funds. These processes mandate trust in the intermediary and require continuous confirmation and validation of balances. The blockchain ledger technology uses cryptography, hashing, and algorithms for proof of work in a process referred to as mining. It creates a new form of digital currency from the tokenization process and introduces a new method of storing immutable data in a distributed ledger. These attributes change or eliminate the need for trust. Undoubtedly, anyone in Treasury management has a vested interest in education on distributed ledger technology and must keep updated on the current technology events in the market. I'm going to share a little bit more information with you about blockchain. It is important to understand a distinction in the operational use of the blockchain tool. These distinctions are determined by the intended participation in the blockchain environment. In the case of the commonly known environments for Bitcoin and Ethereum, the environment is considered open and public. This means that there are no restrictions on participation in the blockchain. The blockchain is completely decentralized and no one has control over the network of users. This allows anyone at any given point in time the ability to join or leave, referred to as public, and the ability to read or write a transaction or even audit a transaction. This is referred to as open within the public blockchain ecosystem. Despite the lack of restriction, the ledger is tamper-resistant and trustless, meaning that it is self-governing without the need for oversight. Another key feature of open and public blockchain environment is the ability to maintain the privacy of the data with control over anonymity and confidentiality. This functionality is maintained through using encryption and the assignment to the user of a key which associates the user with the tokens that are owned. Transactions made direct to the blockchain do not capture any personal identifiable information. Thus, the token address is the control over ownership. Connecting the private key to a user wallet site or implementing the use of a smart contract allows users to also capture and maintain other pertinent identifiable information associated with the transaction. While privacy and confidentiality are important, in an enterprise or industry setting, the use of an absolute, unrestricted public blockchain environment with anonymity is not necessarily practical or desired. Thus, the development of the closed and private blockchain ecosystem. In this type of blockchain network, the participants, both users and miners, are permissioned, and the type of participation is controlled. It is important to understand that it is possible to develop a private or permissioned application that functions on a public blockchain platform such as Ethereum. I would also like to take a couple of minutes to talk about smart contracts and to define what is a smart contract. A smart contract refers to the ability to use programmed automation to affect the exchange of money, property, or other items of value without conflict in a transparent method that requires no trust services of a middleman such as a bank or attorney. Smart contracts are differentiated not only because the contracts define the rules and penalties contained within the agreement, much the same as a traditional contract, but that they also are designed to automatically enforce those obligations. Smart contracts can be described as a series of programmed steps where a record of an asset or currency is transferred into a program, and the program at some point automatically validates a condition and determines whether the recorded asset should go. By recording the movement into a decentralized ledger, the transfer is stored and replicated, giving it certainty, security, and immutability. Because of the efficiency in cost and time and the elimination of mistrust between parties, smart contracts are of intense interest to the global business in all industries. There are numerous exciting blockchain developments going on in the finance area. Recently, the major global banking payment network, SWIFT, announced that it has launched a proof of concept DLT gateway. SWIFT, which has over 10,000 banks in its network, has had a pilot blockchain program in place since 2016. It is focused on serving high-value corporate payments. Visa has also made significant investments in its B2B DLT platform, which is focused primarily on cross-border transactions. These developments indicate that the time has come to recognize the changes that the transition to these platforms will have on our roles within our organization and will have on our everyday activities. Other specific case studies include work that is being done to simplify insurance claims processing, create efficiency in mortgage approval and loan servicing, and to record and report financial data. Financial record keeping and reporting will utilize smart contracts and DLT for improvements in accuracy and transparency in the financial data recording. The B2B ecosystem being developed will ultimately provide an ability to eliminate banks from the daily application of trade finance. The immutable ledger will allow for vendors and customers to exist and share one ledger. My AP becomes your AR. The smart contracts that allow the functionality to integrate will continue to evolve, but there are too many value creation elements, efficiencies, costs, immutability, and simplicity in verification and reporting to restrict the progression of the evolving implementations. Imagine tapping into global unbanked funding sources and a system that allows for near real-time settlement of transactions without the necessity of an intermediary. Now let's shift our discussion and recognize that today there are about 7 billion internet connected devices. Sensors are in everything, and they are controlled by apps that operate on smart devices. Consider the continuing growth of sensors in a world with the maturity in driverless transportation and high-end drone technology. With the use of sensors expected to triple within 5 years, a system capable of machine-to-machine interactions in the transaction ecosystem, designed to be secure, immutable, and transaction fee-free, will further the transformational impact of the distributed ledger technology. Futurists suggest that IoT to IoT transactions in a distributed ledger environment may create new forms of payment and credit management. The final technology that I would like to discuss is the promise of 5G. As you can see from the chart on this slide, 5G, or at least the path to 5G, is underway. 5G promises broader coverage, greater flexibility, and speeds up to 100 times faster than our current 4G. Many feel this technology is critical to the success of mass utilization of technologies such as augmented reality or driverless cars. It is estimated that there will be large-scale and significant, impactful 5G applications available within 24 to 36 months. I would conclude this presentation by asking you to take a moment to think of how impactful any one of these transformational technologies may be on its own. But now realize that the convergence of all of these technologies at the same point in time has the potential to transform finance, much as the internet had transformed media, communications, social interactions, and selling products. We are truly living in the information age, and these are very exciting times for our profession. Thank you for your attention to this presentation today. I hope that it has been informative and you have picked up some useful insight. I would like to thank the Georgia Society of CPAs for allowing me to present this information to you today. If you have any questions, please feel free to reach out to me at marc.hamilton, Hamilton, 62@gmail.com. I would also reference the web address at the bottom of the page on the slide, https www.treasuryandrisk.com, where I have referenced several articles during our conversation today. Again, thank you and have a good day.